Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market today is Mark Marex, Senior Director of Index Research and Development with Nasdaq Global Indexes. We also have Paul Woolman. He is Global Head of Equity Products at the CME Group. And remotely, we have Ryan McCormack, Factor and Core Equity Strategist at Invesco. We're here to discuss Mag 7 earnings and how potentially inflationary policies could impact the Nasdaq 100. It is great to have everyone with us in studio, and of course Ryan joining us. Mark, let's talk about Mag 7 and an earnings recap. They've been pretty good so far.
Yeah, I mean, look, prior to the election, that was the main headline in my view, was just how strong the earnings have continued to come in. I'll give you a couple data points. This year, we are on track for the index overall to still have 20% earnings growth. Next year's estimates now are being revised upward slightly, and we're approaching 20% growth expected for next year as well. So when you look at what the Mag 7 have done, right, most companies have outperformed expectations. Amazon in particular was really strong. Tesla in particular was really strong this quarter. I think they both outperformed by about 25% consensus earnings estimates. Google was really strong as well. To the extent that companies had somewhat, less than favorable reactions in the stock price, it wasn't results this quarter. It was guidance not coming in at the very highest end of what people were expecting going into next quarter and next year. We saw a little bit of that with Apple and Nvidia, but still overall, really, really strong story, really continuing to drive broader earnings growth in the US equity market, with the S&P only growing by about 6% year over year this quarter. When you strip out those Mag 7 names, 3% earnings growth for the S&P.
Yeah, so you can really see, the power behind the puncher, in thinking in terms of the contribution, not only to the Nasdaq 100, but to the market overall. Ryan, a question for you is, if you were to call out a disappointing spot, to Mark's point, it could have been guidance not quite as strong as expected. Perhaps it's a little bit challenging forecasting guidance, not just in terms of the administration coming in, but anytime you have a change in the composure of Washington, there's going to be a challenge.
Yeah, of course, right? I mean, I think the market hates uncertainty, and I think that extends not only to the investor side of things, but also from the business itself. I think the guidance picture, you look at a company like Nvidia, right? I mean, guidance results have been so strong here for now nearly a year and a half, that I think investors kind of expect the world when it comes to guidance. And even in a lot of the releases themselves, from direct commentary from executives, I mean, they kind of position this from a period of strength. And you look at some of the demand for the underlying products of these Mag 7 companies. I mean, all in all, I thought it was a pretty rosy picture. But I think the expectations sometimes can get a little bit overblown. Just to maybe add to Mark's previous point about the fundamental growth that we've seen. I mean, this is projected to be the fastest earnings growth in a year since 2021. We look at 2021 to now, I mean, earnings have grown by over 25% in that period, and we're still looking at 20% earnings growth for the year. So really just, I mean, the fundamental picture of the Nasdaq 100, I think looks incredibly strong. And, I think the fourth quarter will always be telling. You look at, releases from some of these larger companies. It's, far and away their largest release of the year. But it will be very interesting to see in January, just how much the index itself settles on a year-over-year growth basis.
Yeah, I mean, Paul, the performance has been quite remarkable. It almost makes you wonder, what if we did not have this AI theme behind us, what the performance would have looked like? Because at the end of the day, the fundamentals still look really strong in what was largely, an uncertain environment, not just from the U.S. national election, but geopolitics and other macro impacts that the market had to contend with.
Right, yeah. I think that expectations were very high, so that's why we saw this sort of more muted response to what has been very, very strong earnings. We still see good interest, I think, in trading the Nasdaq complex during November. I think in the run-up to the election, there was a little bit of a standoff moment where clients were a little bit in a wait-and-see fashion, but now we're starting to see people come back into the marketplace.
Yeah, especially since that key piece of uncertainty has been removed. So, Mark, the next thing that we have to contend with is, we saw the reaction as it relates to the election results, and to your point earlier, things go up, but they also have to come back down, and you come back to some level of normalcy here. But we also have to factor in what the rate picture is going to look like, what inflation could look like. When you think about the different policies that are on the horizon for the next year or so, and what that means in terms of tariffs and deregulation and how that impacts other sectors of the market.
Yeah, that's right, Jill. I think the key word really is uncertainty, and we've gone from, the months leading up to the election being this sort of big short-term uncertainty as to, who's going to control the White House, who's going to control Congress. Is there going to be a deregulatory push? Most likely, yes, given the way things turned out, right? But I think now we're getting back into a moment of medium-term uncertainty, especially when it comes to some of the fiscal policies that are being discussed, right? Tariffs could very easily turn out to be inflationary, depends how many countries they impact, how many products within country they impact. And we've seen initially some of the reaction from, the Treasury complex, yields going back up sort of towards those year-to-date highs that we saw earlier this year, pre-election. I think the market is starting to maybe sniff out that maybe the Fed is not going to be able to cut quite as much as everyone was positioned for a couple months ago. And that leads me to look at things like, leverage ratios, which we've looked at a bunch here in the past for the Nasdaq-100 versus the broader market versus something like the S&P 500. That index is 50% approximately more leveraged in terms of debt ratios like debt to EBITDA, right, or debt to equity or debt to enterprise value. 50% more leverage than the Nasdaq-100. Half the Nasdaq-100 actually has no debt whatsoever and actually makes more money in terms of interest income today than they pay out in interest expense. So that's an interesting catalyst when you think about it, right? When you think about what happened with performance in 2022, with inflation skyrocketing, with rates going up, this index was, some might say maybe a little bit unfairly punished in terms of the drawdown, in terms of the correction of valuations. But looking out at this, kind of medium-term uncertainty, if we're back to rates are higher for longer a little bit, maybe that's not going to be such a bad thing on a relative basis versus the rest of the U.S. market.
Yeah, and that's a great point that you make, Mark, and Ryan, to follow on with that. It's also going to be the fluctuation in the dollar as well, whether we're seeing more strength or if it gets weaker. Again, I would imagine that the Nasdaq-100, perhaps relative to a smaller cap index, isn't quite as predisposed to it. Some other companies that have sensitivity to what's happening with the dollar and what's happening with rates, particularly if they're, the fundamentals aren't that strong.
Right. Yeah, without a doubt. I mean, I think when you compare it to a smaller company, whether it be uncertainty around fundamental growth, whether it be dollar, whether it be interest rates. I mean, these Nasdaq 100 companies, as Mark had outlined, I mean, they're not rushing to the capital markets to fund projects, right? I mean, they can largely self-fund with some of the cash hoards that they're sitting on. So between profit margin, between some of the leverage ratios that Mark had outlined, I think it gives them a little bit more flexibility, some more wiggle room when it comes to things like higher interest rates and how it may affect their fundamental growth relative to some of the other names out there in the equity markets.
Yeah, I would also argue too, Paul, that it's probably more fiscal policy, the monetary policy, that's going to have a bigger impact, just because our debt load is huge and unsustainable.
Yes, I mean, that's definitely going to play on everyone's minds. I mean, we saw after the US election result, the Russell 2000 actually rallied very strongly on the day. Small caps do well initially and outperform Nasdaq and both S&P 500. However, as market has evolved and rate expectations have tempered down in terms of cuts, we've really seen that outperformance sort of recalibrate. And it will be interesting to see going forward through the rest of the year how each index performs.
Yeah, well, I mean, we also have to get through the first 100 days as well, right? The administration to, put a benchmark in terms of how these policies and tariffs will potentially play out. I mean, we just don't have, a guidebook yet, if you will. But Mark, it's interesting. We're sitting here with Nasdaq. We're sitting here with CME Group, two exchanges at a table, and you typically don't think of two competitors at the table together. So explain to us what you're working on with CME Group, and let's take a look at how the sausage is made here.
Yeah, so I mean, look, we have a very, very long relationship with CME in terms of launching a whole suite of futures products, options products on the Nasdaq 100 mainly, but a few other indexes as well. And we're getting, I think, to the point in our relationship where we recognize we are one of each other's most important clients, respectively, in terms of just how much this futures complex has grown, especially since the launch of the micros recently. And we're trying to come up with a strategy between the two of us. We're having a strategy offsite today, actually, in the building, to talk about how do we better educate different audiences of investors, whether they're retail, whether they're sophisticated or not, whether they're institutional, whether they're advisors. What is the best way to access this preeminent benchmark of the 21st century that we call the Nasdaq-100? There's a lot of different ways to do that, whether it's through the Qs, whether it's through futures or other.
Which is so interesting because when we put this all together, of course, we have Ryan from Invesco, so that's your opportunity to be able to access the index through, the QQQ, which virtually everyone who is an investor is, recognizes. And Ryan, we'll get to that in just a moment here. But Paul, tell us about the trajectory of growth and the performance of some of these products that, are benched to the Nasdaq 100.
Sure. I mean, we've seen really strong growth over the last few years. It was 25 years ago since we launched the E-mini Nasdaq 100 future, and we celebrated that milestone earlier this year, which is fantastic. But if we look at futures and options at CME, based on Nasdaq 100, they've grown extremely strongly over the last couple of years. So we're trading over 2.1 million contracts now through that complex, about 650,000 contracts a day on E-mini Nasdaq 100. But also the micros have been really additive. We've seen active retail traders be very invested in the Nasdaq complex, really want to get exposure to Mag 7, but also Nasdaq overall. And the other angle where we've seen a lot of growth is on the options side. So this year we're trading options on futures, over 85,000 contracts a day. That's up over 25% over last year.
Yeah, and what's great about it is you're seeing that retail advisor and institutional participation. So it really is broad base that you're seeing interest.
Exactly. It's hand by hand. They complement each other very well. You're talking about QQQs. Right. All of these in the ecosystem basically play off each other, and that liquidity moving between all of these instruments in the Nasdaq complex is vital.
Yeah, I mean, it really is great to have issuer, CME Group and Nasdaq all together in one spot here. And I mean, Ryan, the QQQ doesn't even really need an introduction in terms of the growth trajectory, where it is now, and of course, where it's going.
Yeah, I think when you look at what Paul was getting at, I mean, the ecosystem just continues to thrive, and I think the interest continues to grow. You look at QQQ or our QQQM ETF, which we launched just over 4 years ago now. Year to date, they've brought in over $38 billion between the two of them. QQQ is one of the largest inflowing products this year. If all else holds, we may be approaching a record inflow for this potentially record inflow year for the ETF industry as a whole. And I think you look at even over the past month, I mean, the two strategies have brought in over $8 billion. So the investor interest, whether it be going on the derivative side, whether it be kind of your sort of long only traditional ETF, maybe buy and hold investor, I think interest just in the Nasdaq 100 complex continues to grow, and it's very exciting to be a part of it.
It is. More fun products for us as you guys continue to innovate. Appreciate all of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.